Welcome to the Deep Dive. Now, this conversation is actually part of the Journey series by ACE, which, for those who don't know, is a cross-border boutique investment bank, really centered around this global investor and business owner network. Today, we're diving into, well, a really fascinating area, mergers and acquisitions, M&A. And these aren't just, lines on a spreadsheet. They're really specific strategies designed to accelerate growth. So our mission today is to kind of peel back the layers on M&A. We want to understand what makes these deals really work, what drives that success, but also, critically, why so many seem to stumble or even fail. So the big question we're tackling as we look through our sources is, how can M&A genuinely speed up growth in a way that, say, building organically just can't? And maybe more importantly, what are those hidden traps, the pitfalls that can sink a deal? So maybe you can kick us off. Let's unpack the first core advantage that M&A brings, according to the research.
Yeah, absolutely. What the research really highlights right from the start is that M&A gives strategic investors, private equity funds too, a way to potentially get much higher returns on their investments, certainly compared to trying to build a totally new business, from zero. It's about using existing structures, existing assets for, well, better efficiency, often more immediate efficiency. And we're not just talking small gains. The sources suggest a well-done M&A deal could boost ROI by maybe 15, even 20% in just the first couple of years, mostly because you're buying things like established revenues, integrated systems, rather than starting completely fresh.
Okay, 15, 20%, that's definitely significant. So it's not just about speed, it's potentially much more profitable almost right out of the gate. And for you, our listener, I mean, if you're searching for that growth shortcut, this sounds incredibly attractive.
Yeah.
But how precisely does it cut down that investment cycle? Where does that speed actually come from?
Well, a huge part of it is skipping the really hard yards, the most time-consuming bits of organic growth. The riskiest parts, too, often. Our source material really emphasizes how M&A can compress potentially years of testing, developing strategic resources, all into essentially one transaction. Just think about what it takes to build from scratch, right? You've got to win over customers, build up brand recognition, fight for your space in the market, refine how you actually operate, operational excellence, and maybe the toughest bit, finding, hiring, and really gelling a great team.
Hmm.
These things take years, and there's so much uncertainty. M&A lets you potentially acquire all of that already functioning. You inherit something that's ideally market tested.
That's a really powerful way to put it. For anyone listening who's weighing up growth strategies, maybe you're a founder wanting to scale or an investor looking where to put capital, that idea of just skipping those first few years, acquiring proven assets, a ready-made customer base, an established brand, maybe even optimized logistics, it's hugely appealing. It really highlights how much time and money and just sheer effort M&A could save you. But crucially, it has to be done right. Success isn't guaranteed.
Exactly right. And this is where, the insights from ACE's work, as reflected in our source, become really interesting. The material stresses that a really successful M&A deal, the design of it, depends on hitting the mark at three very specific moments or points. We
Right.
call them the M&A milestones. And if you miss even one, the whole thing could potentially fall apart.
M&A milestones.
Okay.
Yeah, that gives us a clear framework. So can you walk us through them? What are these milestones, and why is getting each one right so critical for the deal to actually create value in the long run?
Sure. So the first one is achieving a lower acquisition value. Now, that sounds obvious, right? Get a good price. But it's more than just hard negotiation. It means really thorough due diligence, finding hidden risks, accurately valuing what those future synergies might be worth, and sometimes using quite creative deal structures to make sure everyone's interests are aligned, buyer and seller. Paying too much up front, that's a killer for so many deals. It creates a hole that's really hard to climb out of.
Right, starts you off behind.
Precisely. Then the second milestone, a significant improvement in the business performance of the company you just bought after the acquisition. This isn't just wishful thinking. It has to be part of the plan. You're not just buying it to let it sit there. The idea is to unlock value that was maybe trapped or integrate it so the whole combined business is stronger, more efficient, more profitable. Our source points to needing, say, a really detailed 100-day integration plan, focusing on some quick wins, perhaps, but also carefully managing the integration so you don't break what's already working. A lot of deals fail right here because the buyer either doesn't have a clear plan or they just underestimate how complex it is to mesh two different ways of doing things. And then the third milestone, reaching a higher exit or fair value after a period of time. This is the long game. It means that eventually you can sell the combined business or your share in it for a lot more than you put in initially. This is what really proves the strategy worked. It shows the value was genuinely created. And it requires thinking right from the start about how this asset will grow in value, maybe through gaining market share, new tech, or just sustained better performance. And our source, drawing on ACE's experience, really emphasizes that optimizing the deal design, enhancing value at each of these milestones. That's central to their approach, using well-planned acquisition and building strategies.
Okay, so it's this whole life cycle view.
Yeah.
The price you pay, what you actively do with it, and the ultimate value you realize. That makes a lot of sense. But let's face facts. We hear all the time about M&A deals that just don't work out. They fail. If the goal is to hit these milestones, why do so many fall short? What's the kind of hidden reef that sinks these ships?
Yeah, that's the million-dollar question, isn't it? And this is where the source offers a really, I think, profound insight. Now, failure often happens because, yes, one or more of these milestones just gets missed. Maybe they did overpay, maybe the performance improvements never materialized. But the research points to what it considers the single biggest reason for failure. And it's something that often gets lost in all the financial modeling and the spreadsheets. It's the synergies between the teams. Or, as the source puts it, the people-to-people factor.
People to people.
Exactly. It's not just do the company cultures sort of fit. It's about the day-to-day reality. How do these human beings actually interact, trust each other, collaborate, or fail to? And it really raises this fundamental question. How do you actually build a deal which seems so numbers-driven around something as, well, squishy and human as connection?
The people-to-people formula.
Yeah.
Okay, let's really unpack that. Is it suggesting this is the fundamental thing, more crucial than the finances or the market position? Because, for all the talk about financial engineering, this sounds like a completely different kind of challenge.
The source certainly argues it's paramount. And yeah, it is a different challenge. It suggests this isn't something passive you just hope for, you have to actively manage it. The research describes how ACE, for instance, explicitly uses this people-to-people formula. They're not just looking at balance sheets. They're trying to actively structure deals and build the integrated company around successful human relationships. That means doing serious cultural due diligence before the deal closes. Understanding values, communication styles, leadership approaches, not just the P&L. It means having clear communication plans from day one post-merger. Designing integration processes that focus on keeping your best talent, fostering collaboration, and crucially perhaps, not just seeing integration as a chance to cut costs by laying people off, but figuring out how different skills and perspectives can actually complement each other. Because if the teams just don't mesh, if your key people walk out the door, if the cultures clash badly, well, even the most brilliant financial strategy can just completely unravel. It makes that human element, well, it's your most valuable asset in many ways, but maybe also your most fragile.
That is a really critical point for anyone listening, I think. Whether you're that investor looking for deals or you're a founder thinking about your company's future, understanding this human side isn't just, an HR issue. It's absolutely core strategy. It's not just the numbers. It's the people who have to deliver those numbers and actually work together to make those promised synergies happen. Ignoring that, as you said, seems to be where so many deals go wrong. So just to wrap up our deep dive today, M&A can be this incredibly powerful tool for faster growth. It offers quicker access to markets, teams, resources, and potentially better returns than just building from scratch. But, and it's a big but, the true success, as our sources really drive home, isn't just found in the financial engineering or the strategic fit on paper. It seems profoundly linked, maybe even dependent on the people involved.
Absolutely. And maybe that leaves us, and you listening, with a final thought to chew on. In a business world that's so often focused on the quantifiable, the metrics, the spreadsheets, what does it genuinely mean to structure an M&A deal, to build a combined company around these people-to-people connections? How can you, in your own ventures or investments, really factor that in? Remembering all the while that this human element, it might be your greatest source of value, but also maybe your biggest risk.
A really powerful thought to end on. Thank you for joining us for this deep dive. We hope this gives you some fresh perspective on future investments or growth plans, and maybe a reminder that sometimes the most valuable connections aren't just on the balance sheet.